everyone. As we navigate these challenging times, I hope that all of you and your families are safe. I also take this opportunity to wish you a very happy Dashera, Shubho Vijaya and a happy Diwali in advance. Equity markets in the month of October remained buoyant. The upmove in the Indian markets was in line with the emerging markets which outperformed the US markets. Foreign institutional flows remained resilient. During the month, FIIs were net buyers of Indian equities to the tune of $2.3 billion. Over the last few months, FIIs have been big buyers in Indian equities, especially since the domestic banks have raised capital in order to shore up their balance sheets. MSCI is also set to incorporate new foreign ownership limits in their next rebalancing scheduled in November. Consequently, India's weight in the emerging market index of MSCI would increase. This could, as an estimation, translate into almost $2 billion of passive flows into Indian equities. In the midst of all the challenges that we have faced, there appears a silver lining. Unlike in Europe, the COVID situation has improved rapidly in India. Daily new cases are down 45%, and the death rate is also down since the September peak. More notably, the recovery rates are improving and hence the active cases are declining as well. Large cities seem to now have manageable hospital situation as well, and therefore the hope is that the worst is behind us. However, one must remember that with the upcoming winter season, though milder in India than in Europe and the US, the chances of a COVID case surge cannot be ruled out. The festive season is a risk as well. However, we believe that with the current improvement in the situation, the probability of a government enforcing strict lockdowns again seems to be low. On the global front, liquidity continues to remain ample. Central banks around the world have kept rates low and their policy stance remains accommodative. The US presidential elections are around the corner and the outcome is being closely watched. On the domestic economy front as well, high-frequency economic indicators in October shows that the ongoing revival in economic activity continues unabated and we are getting closer to the pre-COVID levels. After inflecting in the last quarter, the long-term trend indicators of growth are now making deeper inroads into the recovery phase. These indicators that we track include passenger vehicle sales, mobility data, e-way bill, electricity consumption, petrol-diesel demand, GST collections, the PMI manufacturing index, to name a few. However, the trend of these indicators post the festive season needs to be watched closely as well. On the policy front, while there were concerns about inflation, and that probably deterred the Monetary Policy Committee from cutting the repo rate in the October policy, the minutes of the policy meeting highlights that the members expect that the recent inflation readings are likely to be transient, driven mainly by supply-side disruptions as well as high food prices. We believe that the current scenario of negative real rates would continue and RBI will keep the overall policy stance as accommodative and ensure liquidity is ample in the system. The central government too has outlined measures to boost consumption just prior to the festive season. The government continues its journey on the structural reforms path with the focus of improving the share of manufacturing in India's GDP. Reforms on labor and agriculture are also steps in this direction, and this along with the launch of the production-linked incentive scheme starting with mobile phones and parts and pharmaceuticals is expected to boost manufacturing. The quarterly earnings season of Q2 FY21 is also underway. Expectations were muted, however, the earnings so far have been better than expectations. The key highlight thus far has been the strong improvement in margins, leading to growth in operating profits. The management commentary by and large seems to suggest that companies are well on their path towards demand normalization. The continuation of this trend post the festive season is critical. Also, the organized sector is benefiting at this point in time due to a market share shift from the unorganized space, and companies with strong balance sheets and cash flows are faring much better. The key trend that is sustaining is that rural demand continues to do well, especially so in housing, which is positive for sectors such as cement, building materials, and consumer electricals. In terms of valuations, while the large cap Nifty index is trading somewhat above its long-term average price to earnings multiples on a 1-year forward basis, on a price to book multiple, the valuations are not much higher than the long-term average levels. Earnings expectations are, however, factoring in a sharp revival in FY22 of a low base in FY21. With this, the future direction of the market will depend on the continuation of demand trends post the festive season and the sustained improvement in the COVID curve. Therefore, we believe that today the market is more micro in nature and hence bottom-up stock picking is the way forward. In this respect, we strongly believe that we need to focus on companies that have strong balance sheets, low leverage or debt, variable cost structures and cash flows which are strong, and also those companies that are gaining market share in their respective industries. The transmission of lower rates has improved especially to companies which have stronger balance sheets. Further, while small and mid caps have risen from their March lows, they are still much lower than their January 2018 highs. Our focus is on positioning the portfolio in such sectors and companies to take advantage of earnings recovery. Also, we believe that FY22 should be a more normalized year for economic growth, and also therefore when the economy turns the corner and growth rate increases, we believe mid-cap companies would benefit since they are geared towards economic growth. Our belief is that bottom-up stock picking approach will be rewarded, however one would need to be patient. We follow a balanced approach to portfolio construction with presence in domestic cyclicals like cement and industrials and large private sector banks, as well as defensives like IT or technology and consumer. Some of the key structural themes in our portfolio include identifying companies that benefit from consolidation or market share gains in their respective sectors. The shift from the unorganized to the organized sector continues. Supply chain shifts away from China to India is also a theme that we continue to see going forward. The rural recovery remains strong, while at the margin urban indicators are improving, and financialization of savings remains a structural theme. The human race is extremely resilient, and as Nelson Mandela once said, "Do not judge me by my success, judge me by how many times I fell down and got back up again." We continue to believe that given the current backdrop, timing the market is very difficult, and hence time in the market is far more important as a step towards long-term wealth creation. We believe that one should stay disciplined in their approach to equity investments, and the systematic investment plan is the best way forward. Stay safe, stay invested. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
5 पैसा के प्रोडक्ट्स और सर्विसेज के बारे में ज़्यादा जानकारी के लिए और लेटेस्ट अपडेट्स के लिए हमारे YouTube चैनल को सब्सक्राइब कीजिए। 5 पैसा के साथ निवेश और ट्रेडिंग की शुरुआत करने के लिए 5 पैसा मोबाइल ऐप डाउनलोड कीजिए।